Okay, here's the buzz, here's the deal, here's what's happening. We're going to look at steps 2, 3, and 4 of the accounting cycle: creating journal entries, posting two ledger accounts, and creating a trial balance. To refresh our memories, we're trying to create our financial statements, and the way that we create those financial statements is through the accounting cycle. The first step in the accounting cycle is to analyze a transaction and see if there's something for us to record. If there is, then we create a journal entry with debits and credits, and we already know our rules for debits and credits. Then we post those debits and credits to individual ledger accounts, and then we strike a trial balance. Let's take a look at 4 simple transactions and walk through steps 2, 3, and 4. Transaction number 1: on September 1st, the owner invests $15,000 cash into the business. Cash is an asset, it's increasing, so we're going to be debiting cash. Owner's equity is increasing, so we're going to be crediting owner's capital. So we put out the date here, we write the account titles: debit cash for $15,000, credit owner's capital for $15,000. The next transaction, the company buys equipment for $14,000, putting $8,000 down with the balance on account. Equipment is an asset, it increases with debits. Cash is an asset, it decreases with credits. And accounts payable is a liability account, it increases with credits. So there's our date, there's our debits, there's our credits, and we always want to remember to make a little note to remind ourselves and the next person exactly what happened with that transaction. The third thing that happens is the company is paid $7,000 for consulting services performed. Cash is an asset, it increases with debits. If expenses are debits, expenses are debits, expenses are debits, the opposite of expenses, revenue or sales, they must increase with credits. So we credit service revenue for $7,000. We could call it consulting fees earned, we call it fees earned, we could call it sales if we wanted to. The point is it's a revenue account and it increases with credits. It keeps track of our sales, whether we get paid today, tomorrow, or never. And the fourth and final simple transaction is we pay rent of $1,000. Why don't you pause this video and see if you can make that journal entry. I hope you got it. Expenses are debits, expenses are debits, expenses are debits, so we debit rent expense for $1,000. Cash is an asset, so it increases with debits and decreases with credits, so we credit cash for $1,000. So my boss walks in and says, "Russ, how much cash do we have in the bank?" And I say, "I don't know, boss. I haven't posted yet." So posting is the third step in the accounting cycle, and it's just about organizing this information in a little different manner instead of chronological, by category. So we'll take this journal entry here, debit cash for $15,000. We'll post that $15,000. We'll move that information to a separate page in the general ledger, and we'll debit that account cash for $15,000. We'll do the same thing with this $15,000 credit. And this is called a 3-column ledger because we've got debits, credits, and we keep a running balance out here: debit, credit, and a running balance. And that's all well and good, but in this class, let's just use T accounts. So T accounts are just representations. This will be cash, this will be equipment, this will be the debits, this will be the credits, and to calculate the balance, we'll just offset the debits against the credit. So for example, when we post this first journal entry here, we debit cash for $15,000. Remember, debit means left. And we credit owner's capital, credit means right, for $15,000. We stick a little date out there. And then we do the same for all these other transactions. And so we have a graphic representation of what those individual ledger accounts look like with all their debits and the credits. But what we don't have is the balance. So when we use T accounts, the convention is 15 plus 7 is 22, minus 9 is 13. We draw a line, and it's the debit balance. If it's a debit balance, we write that balance on that side. There's no more arithmetic to be done on these others because they all have just one entry. And that's step 3 of the accounting cycle. We take the journal entries, which are in chronological order, and simply reorganize that information by account. And the last topic for today is step 4, the trial balance. Here's the trial balance. We put the company's name at the top, the name of the statement, the date, debits in the left-hand column, credits in the right-hand column. It's really important that we list the accounts in a particular order: assets, liabilities, owner's equity, revenue, and then expenses. And the mistake that students often make is the first time they create a trial balance, they would put, say, $22,000 here and $9,000 here for all the debits and credits that's in the cash account. We don't do that. We put the balance in that account. We had $22,000 for the debits. We had $9,000 worth of credits. So we had a $13,000 balance. That's what we put here. So we add up all the debits, we get $28,000. Add up all the credits, we get $28,000. Does that mean we did everything exactly right? No, we might have debited cash when we should have debited accounts receivable. We could have made a mistake, but this is a hell of a lot better than having $32,000 here and $26,000 here. So we're on the right track. So step 2, make journal entries. Step 3, post them, put them in individual accounts. 4, run a trial balance to make sure all our debits equal all our credits. Hope that helps.